Good morning, everyone. Thank you so much for joining us. I'm just going to do a very brief introduction into who Icon is for those of you who might be joining who don't really know us and know what we're about. And then I'll be introducing Jono and Brad, who will take you through the bulk of the session today. Okay, so myself, I head up marketing at Icon. And put together content like this, and also work very closely with a group of financial advisors based in Durban. Next, we have Brad, who heads up the business and the team and kind of manages all the relationships with the product providers. And then we have Jono, who is actually a co-founder of Icon, has been around at Icon for a long time now, and he also manages key relationships and heads up operations. Cool. So why does Icon exist? Just a quick recap. So the macro problems we aim to kind of help solve in the market. And the first one, and I suppose the major one on the risk and investment side, is really the fact that we have a massive problem when it comes to retirement and people who kind of are aging but can't afford not to work and kind of are left in a dire financial circumstance as they get older. So the South African stat currently sits at about 6%, which I think is actually quite inflated for various reasons. But I mean, it's a real small fraction of the country who can afford to retire somewhat comfortably. But despite this, we have an aging group of South Africans that are heavily overinsured by about 200% or have about double the amounts of cover that they need. And we'll really unpack this in the session, and really what the session aims to achieve is how we can change this kind of imbalance of cover levels in our client bases, with using some income benefits to solve that. The other point that Icon really is aiming to change in the market is the fact that over 75% of life new business annually is effectively churn. And some of that is needed, and we obviously review our clients every year if we're doing a good job. So some of that is warranted. But there's a large portion of clients that are not being served with financial advisors. And at Icon, we're passionate about advice, and we do believe that humans actually need a financial advisor to walk them through the process. And so we really want to make the whole advisor practice structure far more efficient so that they can afford to see clients that perhaps are not affluent, or they're kind of higher tier of clients. And we really believe that this will open up a much broader market to advisors if their whole structures are far more efficient. So the greater vision of Icon is really to democratize great financial advice and deliver the best value to customers, enabling their financial freedom. And then the mission on the advisor side is to help financial planners on the risk insurance side specifically. We do have investment solutions that are very easy to plug into your practice, but really to take a lot of the risk and stress out of risk planning with your clients so that you are freed up to focus on client relationships, growing your practice profitability, and growing the client's wealth through investment solutions. On the client side, we want to get the best product fit and value for customers. And we see far too much of kind of wallet share or share of their pocket being kind of spent on risk benefits, and often not the most efficient risk benefits, and then really not saving enough for retirement. And so by doing this, we really want to allow more South Africans to have a better future and to grow wealth along with doing things more effectively. Cool. I'm going to hand over to Brad now, and then Jono will wrap up with the kind of key points and the way we've segmented the different markets.
Thanks. Morning, everybody. I look at myself in the camera now and I realize I probably shouldn't have worn the grandfather cardigan, but it is chillier in Durban than it has been the past few days. So this morning, we're going to be talking about life income benefits, and I suppose more specifically, how we think they're a great addition to a financial advisor's toolkit. I'm going to try and start macro and almost give a helicopter view, and then as we get closer and closer, I'll hand over to Jono to really talk about the specific opportunities that come out of the life cap, the way we can construct solutions with life income benefits. If we start big picture and we look at the South African market, and this is a stat for me that terrifies me, but also it contradicts some of the earlier information that Grace just gave us, or not contradicts, it looks interesting in that context, is that the most recent study said that there's a 28 trillion rand gap in insurance in South Africa. So that means that South Africans have 28 trillion rand less cover than they need. And I often make this point when having this discussion that that number is so big that it becomes overwhelming. I don't even know how many noughts are in a trillion, let alone how to go about trying to solve that problem. But when we break it down a little bit further, I think the stats start to tell us an actual story. So when we understand how does that gap change over the different demographic profiles, you see that in the 20 to 35-year-old age group, South Africans basically have no insurance at all, or at least the gap there is at its biggest. In the 35 to 50-year-old age group, we're starting to get a little bit closer to the type of, or the amount of cover that we need in place, but not necessarily the type of cover. What's really fascinating, though, is the number that Grace opened up with, is that in the 55 and over age group, South Africans have twice as much life cover as they need. And how do you put that next to the next stat, which says that only 6% of South Africans are able to retire and able to afford to retire? And it's really those two that Icon wants to fundamentally change. And that's our opportunity, is to say, how do we rebalance the spend? How do we shift the spend from risk cover at the older ages to investments and savings so that South Africans can actually fundamentally change their financial future? The reason why we think this is happening is because of the industry's over-reliance on lump sum benefits to solve every insurance need, particularly in the life cover space. If you think about life insurance the way we do, effectively insurance or risk cover exists to make you financially neutral. You shouldn't be enriched by it. You should be in the same financial position as if that horrible thing never happened to you, whether it's injury, illness, serious illness, or death. And if you see the world the way we do and you think about it like that, ultimately your need for insurance or your need for risk cover should be measured by the amount of income that you would be unable to earn, unable to provide in your future. And again, if you think about it like that, your need for life cover actually reduces as you get closer and closer to retirement age. The analogy that we often use in this industry is that risk cover or insurance is protecting your income statement, and investments or savings is growing your balance sheet. And in a perfect world, as your balance sheet gets stronger and stronger, as you get closer and closer to retirement, your need for risk cover decreases. Similarly, as your income years ahead of you get less and less, the amount of future income that you're able to protect is shrinking. And when you look at this graph, you realize that lump sum benefits behave in exactly the opposite way. So we often put lump sum cover in place for a younger person coming into the market. They can't afford the amount of cover that they need. They end up being underinsured here, but every single year that amount goes up by a fixed percentage or gets reviewed every single year, and you end up with this situation. When the years coming up to retirement, most of us end up having way more life cover than we need. And that creates a problem that's very difficult to solve. I remember a year or two ago, I had a similar discussion with an advisor, and he told me the story of a client that visited him just the day before. He was in his 60s, an extremely wealthy man, but was paying 45,000 Rand a month for life cover. And the only advice he could give this individual was cancel all of it because you don't need it. Now that's 5 to 6 years of excessive risk premiums that individual was unable to allocate towards savings, retirement, or even just basic lifestyle. So what are the benefits of income solutions? Why do we speak so strongly about the case for income benefits against lump sum? And maybe I shouldn't say against lump sum, as an alternative to lump sum, and very often as a complementary solution within a financial plan. Most of these benefits, I think, or these advantages have become almost accepted in the disability space. If you look at the trends in the South African market, particularly in the last 10 years, there's been an incredible shift within the disability space from lump sum almost exclusively to income benefits. What's surprising to us is that every single one of these advantages apply in life cover as well, yet it's almost the last part of the industry to accept this change, or the last part of the planet. And all of these advantages apply exactly the same in life cover. And why is that almost the best kept secret now? So here's a quick summary of some of the risks, or I guess the disadvantages of a reliance on lump sum benefits over income. But maybe just to give it a personal story, I know that when I sit with my advisor and he says to me, how much life cover do you need? I express that back to him in an amount of income that I would like to leave my loved ones. That's the way we think about our lives. That's the way we think about our financial futures. So I sit with my advisor, I express my needs in income terms. He takes that, puts a whole lot of complicated assumptions and calculations to it, gives me a lump sum back. That's the amount that I need to insure myself, so that in the future, we can then take that lump sum, once again, reinvest it and turn it back into a lump sum, back into an income. So we have this bizarre situation where we see our future needs in terms of income. We convert that to an equivalent lump sum so that one day again, we can invest it and turn it back into an income. And the beauty of life income benefits is it cuts out that middle step. It expresses our insurance needs in exactly the way we as consumers think about our lives, and it removes all of these risks that I'm going to cover here. The first one is you don't need to calculate a lump sum amount to generate a future income stream. It removes all of those assumptions you need to make around future investments, inflation, and even assumptions around longevity. You don't need to worry about the risk and the capacity of investing a large amount of money and having to calculate the tax implications of those tax returns. It removes the worries of loved ones running out of money before they pass away. And most importantly, it takes away the temptation to spend a lump sum payout on expensive luxuries, leaving your dependents with nothing to pay the bills. Interestingly, I've always told this story for years and years and years about the lotto winner effect and how people receive a large lump sum of money and are irresponsible with it and have nothing left. More recently, I've come across a situation with family friends of ours who are actually sitting in exactly the opposite. They have a lump sum of money, but are so cautious and scared to invest it that they're actually not able to enjoy their lives every single month because they live with this fear that the money's going to run out or they don't know how long they're going to live for. And that's what a guaranteed income stream does for your loved ones. It gives them the peace of mind to know exactly how much money they have every single month so they can make decisions, they can choose how they want to live, and that your loved ones will be taken care of in exactly the way that you intended them to. This is a summary really of some of the points I've covered, but effectively what we're proposing is that what life income benefits do is over the lifetime of your clients, match the needs that they have. It moves exactly with the pattern of how their insurance requirements shift over time. And it moves us away from the situation where South Africans are grossly underinsured in the younger ages and dangerously overinsured in the older ages, and gets to the point where putting a life income benefit in place here means you can actually keep your clients correctly insured from day one until the day they retire. What this does more powerfully is allows us as an industry to start to realign or to shift the spend from risk cover at the older ages and allocating that money, or as Grace referred to, that share of wallet, to investments and savings at a later stage. And I looked at some of the people that have signed up for this morning's webinar, and I recognize a lot of your names. There's a split between advisors who focus on risk planning and advisors who are investment advisors only. In fact, there's even some asset managers in the meeting with us this morning. And you might be wondering, well, how is a discussion around life income or life insurance relevant to an asset manager or an investment-focused advisor? And my argument is this is where the relevance comes in, is that we as an industry need to drive this change, move from a reliance on lump sum benefits to income benefits. And one of the many consequences of that will be the fact that we're now freeing up available cash to be able to allocate towards investments and savings. And in doing that, we can fundamentally start making a dent in that opening stat that only 6% of South Africans are able to retire. So what are life income benefits? I mean, the good news is that the solution to this problem we talk about already exists. In fact, it's existed for a while. Life income benefits are a monthly income benefit that pays out to a dependent, a business, or to your estate in the event of death. What it isn't is a lump sum just spread out over a few months or paid out in tranches over a fixed term. This for us is one of the biggest myths that we need to overcome about life income. In many ways, we think about it like ivermectin. This is a medicine or a pharmaceutical drug that's existed for many, many, many years and stayed under the radar until more recently it's become popular and very well known as an unexpected solution or cure to COVID. And in a funny way, I know we're stretching the analogy a little bit here, but life income has been around in the industry for way more than 10 years. But it still remains the industry's best kept secret. It still remains the most underutilized benefit that we see in financial planning today. And that's really what we're trying to change. We believe that the time for life income has come now. And it helps you take the risk out of giving risk advice. And the partners that Icon works with, Sanlam, FMI, and Capital Legacy, each of them in their individual capacity happen to be extremely strong in the life income space. But collectively, they're even more powerful. And that's what we're able to do for you. Through the combination of the life income benefits available through our product providers, we really believe there is every option available to create the most unique, specific solutions for your clients. You can create solutions for spouse, for children, for divorced clients, for dependents who have aging parents, for business owners, even for estate planning. And that's what Jono is going to cover in a little bit more detail as soon as I'm finished. So the beauty of life income benefits is it allows you to structure your cover exactly the way you need. You choose how much income you would like to leave to each beneficiary, and this is along the top here, and how long you would like to leave that income for. And because of that flexibility, you can truly customize a solution that meets the specific needs of each client. In many Icon presentations, Jono likes to use the analogy of Icon being tailors, where we get the information, we get the measurements, and we can cloak your client in a tailor-made bespoke suit. And no more so does that apply when it comes to life income benefits. They are unbelievably flexible, and it allows you to create literally any solution you can think of. And with that, I'm going to hand over to Jono to take you through some of those specifics. And I hope what I've tried to paint the picture is that as an industry, we strongly believe that up until now, life cover particularly, there's been an over-reliance on lump sum benefits. And that the emergence and the existence of income benefits in the life space gives us an alternative, gives us a great solution to start shifting that away. And one of the consequences of that is that we're going to put cover in place that actually meets the needs of the clients perfectly, but starts to free up spend, particularly as the clients are approaching retirement age, and allows us to redirect that towards income, towards investment and savings. So thank you.
Thanks, Brad. Cool. So the next section of the presentation, I'm just going to take you all through 6 very specific opportunities that already exist in your client base. And I think what's important to keep in mind while I go through these is that using a life income solution for these 6 opportunities doesn't necessarily mean that you now need to go back and undo the planning that you've already done. In a lot of cases, life income can be used as a supplement to the existing cover that's already in place. Or what we like to suggest doing is you can actually also go back and rebalance existing portfolios. So by making this shift in the way you plan and put solutions in place doesn't necessarily mean that we now need to go and see all of our clients and say, you know, what we have done for you already is wrong. So again, life income is really just another tool in your toolbox, like Brad said, and it can be used to supplement what's already in place. And I think the biggest opportunity, and probably the most obvious, is providing for our loved ones. It's generally the thing that we're most concerned about. I think it's one of the reasons why life cover is the most sold product in South Africa, is because this is the need that we care about the most. And life income really is the perfect solution for providing, I guess, a replacement of income for your spouse or partner. And all of the risks that Brad has spoken about are mitigated or removed through the use of a life income benefit. We don't need to make assumptions when it comes to calculating a lump sum. When you sit down and speak to your clients, a lot of them express the need in a monthly income. So it's very relatable for a client when you put the cover in place in the form of a lump sum. And in terms of assumptions, when we make an inflation assumption or an investment assumption over a 30 or 40-year time horizon, if any of those assumptions are off by even 1%, the impact in that planning can be thrown off completely over that term. What's really nice, especially with the product providers that Icon works with, is that we have so much flexibility in terms of cease ages and fixed terms. So what we like to do for spouses or partners is actually use a retirement age, where you can provide a predetermined amount of income, increasing at inflation, up until the age of 65 or 70. You can also put a whole of life payment period in place over and above that. So for example, we can cover 100% of your spouse's income to age 65, at which time they need to retire. Post-retirement, though, we could put a whole of life income benefits in place, which will supplement the retirement planning that's been done. And that really gives clients peace of mind that all of the basic needs are going to be taken care of for your spouse, regardless of circumstance, regardless of longevity, and regardless of the way markets perform. And I think a big one there is medical aid expenses. What's also great about income benefits is that the retirement planning still needs to be put in place. So if you do pass away and you leave an income to your spouse up until a retirement age, a portion of that income still needs to be reinvested, and you're still going to be very much involved in that client's life, because at some stage that income will either reduce or fall away. The next big opportunity is for children. Again, a massive part of people's lives, and what's become massively popular in recent times are education benefits. The problem with the existing education benefits that we have available to us, though, are that they're very prescriptive and they're extremely expensive. So the way education benefits work, typically an amount of money is paid over directly to an institution to avoid that money being misappropriated. But the unintended consequence of that is that kids have to go to varsity, they have to go to a specific school that's listed on the benefit. And very often these days, kids don't necessarily go to university straight out of high school. A lot of them want to travel, they want to take gap years, they want to start businesses. And a life income benefit is really the perfect solution to giving children that flexibility. Another great use for life income when it comes to providing for children, and it's often not taken into consideration when we're doing lump sum planning, is the additional expenses associated with being a single parent. You're going to have to hire an au pair, you're going to have to hire a tutor. These are all huge monthly expenses that also need to be catered to. And what's really nice about our existing suite of benefits is the specific cease ages that we have available to us. So we can leave an income to a child up until their 24th birthday, for example. By perfectly meeting that need, we can actually drive down the cost of that benefit significantly. So when we're comparing a life income education solution to an off-the-shelf education benefit with all the bells and whistles, the price is generally more than half when we compare rand for rand. Something in our generation that, again, often isn't catered to is the need for dependent aging parents. We live in the sandwich generation. And many of us are actually looking after children as well as our parents, which is a massive financial burden. With whole of life income terms through the likes of FMI, we can actually ensure that our parents are taken care of. I think, again, medical expenses are the biggest concern here. And we can leave a guaranteed income for your parents' entire lifetime, increasing with medical aid inflation. And the sad thing with aging people is that they're often the ones who are taken advantage of the most, especially when they get large lump sum payouts. So what we can do with a life income benefit is actually mitigate that risk. They're going to have certainty. There's going to be no confusion, and they're not going to have to worry about reinvesting that money, which can be a massive burden, especially for an older person. I think I skipped a slide. If you just want to go back to divorced parents or maintenance agreements, alimony. Again, this is something that's often overlooked when it comes to financial planning. And let's be honest, no one wants to leave a large lump sum of money to an ex-spouse. You hear horror stories of money being misappropriated, being spent on new girlfriends or boyfriends. But again, with a life income solution, you can leave an income to a specific age of a child or for a fixed period of time, depending on what the agreement is. And you can have peace of mind that that income is going to be used for its intended purpose. Another opportunity that is often overlooked is business assurance. So we all understand buy and sells, key person cover, and the need in this sphere is almost always taken care of with a lump sum. What we often don't think about is when a buy and sell is triggered, during that transition phase, there's a lot of friction. There's a key person who's left the business. Very often when that happens, a lot of value within the business is lost. That person holds key relationships. They have deep understanding of the industry and the business. And when they're no longer there, there's often a drop in cash flow. And there's often a period in which the business actually loses a lot of its value. So in combination with a lump sum to take care of the exchange of shares, a life income solution is perfect to bridge the short-term cash flow constraints where there's a handover in management. It's also a fantastic solution for key person needs. Key person requirement is a monthly recurring need for a predetermined period of time. You can cover the income for the replacement party. And again, you can also cover that short-term drop in cash flow. And then a really nice opportunity here for business assurance is also for smaller businesses where there isn't necessarily a buy and sell in place, where you can put in place almost a bridging solution for existing employees. While they transition from one employer to another, you can give them security that they'll continue to receive their salary for a period of 6 months. And that's something that's really awesome for a small business owner to give their employees. And then the last opportunity, which I think isn't catered to at all, at least in my experience, is short-term estate liquidity. So in South Africa, estates on average are wound up in about 18 months. During that period, all assets are frozen. So it can be very, very stressful, especially when there's unforeseen holdups in the estate administration process, where dependents can't get access to funds. If there's estate liquidity issues as well, very often the life cover payout, the lump sum life cover is eroded. And that's used to pay for executors' fees, transfer duty, master's expenses. So what beneficiaries are having to put in doesn't give them the cover that they were expecting to get out. when that unexpected death took place. What we can do with estate planning from an a life income perspective is leave a short-term benefit for either 6, 12, or 24 months that will pay directly to your beneficiaries. And that will give them the cash flow that they need whilst the estate is being wound up. Another incredible benefit, which not many people are aware of, is actually the tax efficiency of life income benefits. So from an estate duty perspective, there is a provision made within the Estate Duty Act. So it's section 5, subsection 1, paragraph D, if anyone wants to go and read it, but we can share it with you at the end of the session. But what that does is it actually provides tax relief for annuity-based products. So that's investments, life annuities, but also risk products. And what that does is it gives a tax rebate of 12% per annum over the term of the benefit payout. So when we work that back, the tax duty or the estate duty savings are significant. And just one example that I've done here on a very small amount of life income of 10,000 Rand per month over a 30-year time period. If we look at the present value of that income, it works out to around 2.75 million. However, with the 12% per annum rebate, the deemed property within the estate is only 1.725 million Rand. So that's relief of R1 million in terms of deemed property, but it's a tax saving of over 200,000 Rand. And from an estate duty perspective, that's massive. So this is kind of the hidden golden nugget when it comes to life income from an estate planning perspective. You're going to save your clients a lot of money on tax. So those are the 6 immediate opportunities with life income. And I guarantee you can find 1 or 2 or even 3 opportunities there for each and every single one of your clients. All right, so we're going to go through some live examples, but before we do that, I just want to address probably the elephant in the room. And this is probably the biggest objection we get when it comes to life income. And that is that when a lump sum is paid out, that's obviously an investment opportunity for you. You can build your AUM that way. And how does life income, I guess, affect that? So the first thing, just off the bat, is we're not saying at all that life income should replace all lump sums. There's obviously capital needs, which should be catered to with lump sums, but there's ongoing monthly needs, which should be catered to with an income. So we believe in using both of them in combination with one another. Where we believe life income really creates an investment opportunity for advisors, and Brad spoke about it earlier, so did Grace, is instead of 1 out of 100 of your clients dying and you receive the lump sum to reinvest, what we would suggest doing is get 100 out of 100 clients to make the switch to income-based benefits. And through that, you're going to create significant premium savings. Those premium savings should be used to boost retirement contributions or investment contributions. And that way, you're able to grow your investment AUM across your entire client base. And you're not just reliant on the handful of life cover payouts that you're going to be getting over your career. The other thing that we've experienced is claimant behavior. So when a claimant receives a lump sum payout, how much of that are they actually going to reinvest? In the numerous life cover payouts that I've kind of helped with and experienced in my career, that payout's often severely eroded. So family come out of the woodwork, parents, uncles, you want to give some to your kids. Bankers also come out of the woodwork, other advisors, and there's a host of investment opportunities that are thrown at the clients. in most cases, the amount that comes back to the advisor is a lot less than the initial payout amount. Through using a life income, however, the beneficiary that's receiving that payout is going to need ongoing financial advice from you, the advisor. They're going to need risk cover put in place. They're going to need retirement planning put in place. And we believe that opportunity is far more sustainable, and the value of that client over their lifetime is going to be far greater than just a once-off lump sum payout. All right, so we're just going to move on to a life income example. And this is a live quote example that we've worked on with an advisor. And if you just go to the next slide, this is a 45-year-old client, and they have a spouse and 2 children. So this is just looking at catering for dependents in the event of death. The premium for the solution is 1,567 Rand. The premium pattern and annual benefit increase are kept consistent in this example. And there's 3 dependents. So there's a spouse and 2 children. In this particular example, we've left 25,000 Rand to the spouse up until age 70, and we've left 10,000 Rand per child up until the age of 24. The combined present value of those 3 incomes over the different terms is just over 8.7 million Rand. So what we've done is we've taken that present value and we've done a lump sum quote. So the equivalent lump sum costs 2,246 Rand. That's 43% more expensive than the income solution right off the bat. The difference in premium is also going to grow over the term of that policy. And what I mean by that is the life lump sum is going to increase at a greater rate than the equivalent life income. So we just go on to the next slide. If we were to reinvest those savings of 680 Rand per month, and this is just a very rough calculation, over a 15-year time horizon, so this client's 45, if we invested up until 60, which I guess is probably the earliest realistic retirement age for all of our clients, at a rate of 10% per annum, the retirement boost by making that one subtle change in cover is going to be roughly 550,000 Rand. That doesn't take into account the tax savings through the estate duty benefits that I just discussed. And if we go on to the next slide, which shows a graph, if you look at, I guess actuaries will call it the jaws of the income benefit versus the lump sum benefit. It starts off relatively small, 680 Rand per month. But in 15 years' time, the premium saving per month is around 3,000 Rand a month. Leading up to retirement, that can be contributed to your retirement savings, and that's going to give you a massive boost when you enter retirement. And what's really great about those savings is that they're guaranteed. So all of the insurers, or most of the insurers, have come up with these awesome incentive schemes. They look amazing on paper. You're going to get millions of rands back when you reach retirement age. But the reality is there are so many hoops to jump through. And I can't tell you how many times we've seen people who are in retirement who are paying massive amounts of money for their insurance. And the only reason they're doing it is to get the carrot at the end of the term. To Brad's point earlier, high net worth individual paying 50,000 Rand per month for their insurance. We see people who are not high net worth individuals paying 50,000 Rand per month for their insurance. They don't have any money to live on because they're hoping that in 2-3 years they can get this really nice payout. If they claim during that period, yeah, they don't get anything, or they get a massively reduced amount. So there's no what ifs with this, and it's guaranteed savings from day one. So I'm just going to recap. And the way I like to do this is breaking down the benefits of life income, but at each stage of the advice journey. So there's 4 stages that we've identified: the planning stage, the in-force stage, or the policy life, claim stage, and then post-claim stage. So from if we look at the planning stage, we've kind of driven this point home, but there's far fewer assumptions when it comes to using an income-based solution. All we really need to do is ask ourselves, how much are you earning currently? And how much of that income is being allocated to each need? We don't need to assume inflation. We don't need to assume investment returns. We don't need to assume longevity. We don't need to assume interest rates. And again, if any of those assumptions, which they almost are always incorrect, if they're off by as little as 1%, the impact on your planning can be catastrophic. There's also premium savings upfront. So this is going to look far more attractive to your clients from day one. In terms of the in-force stage, income benefits are far easier for clients to understand. And it's really easy for a client to open their benefit statement and to see each of their dependents listed on there and the amount of income that they're going to be receiving in the event of your death. Because of this relatableness, income benefits have far better lapse experience. So they stay on the books far longer than lump sums do, which is very interesting. The graph that Brad showed earlier, income benefits avoid overinsurance. So by selecting very specific need terms, we can ensure that our cover maps that need almost perfectly. We can close the insurance gap from day one because the benefit is cheaper. We can avoid paying exorbitantly high premiums whilst we're in retirement. The benefit is much easier to review. So again, we can open up a benefit statement. We can see how much benefit is being allocated to each beneficiary. And we almost always know what that benefit's being used for. Kids is for education, spouses for food, rent, medical aid. Where it becomes very difficult to review a policy is when it's a lump sum. How is that lump sum broken down? Who's it allocated to? The only way we can really determine that is by looking at beneficiary splits or an FNA. So it's time consuming. And then the last one is the premium savings grow. So that graph I just showed, the jaws of the graph open over time. And as that policy progresses, your savings are going to grow over time. At claim stage, income benefits are far more tax efficient from an estate duty perspective. And you have peace of mind that your loved ones are going to be looked after as you intended them to. There's going to be no unknowns or very few unknowns that are associated with lump sum cover. And then lastly, post-claim, where I think the benefits are actually the most compelling, is your loved ones have income to live their lives. They don't need to worry about managing a lump sum. They don't need to worry about outliving a lump sum. And I guess that makes that post-death period, which is usually traumatic and stressful, far more manageable. It removes the obvious behavioral risks associated with the lotto effect, or converse, the stingy effect, where you're too worried to actually spend your lump sum, or you blow it all in a couple of years. And then it mitigates investment risk. So I think a huge thing here is sequence risk, especially considering the markets that we've had consistently over the last 5 or 10 years, barring last year. And the investment planners will know, if you receive it, or if you invest a lump sum and you draw down during poor market conditions, those first 2 or 3 years are crucial. And if you're drawing down whilst your units are losing value, that's going to have devastating impacts on that value going forward. So you can use a lump sum, but you can also mitigate sequencing risk through the use of an income as well. And then the last one is longevity risk. So we can use income benefits to reduce that or remove it entirely with whole of life income. And that's my summary in a nutshell. I think I'm just going to hand over to Brad to close things off. And then there are a few questions in the Q&A. So while Brad's kind of summing things up, please pop your questions in the Q&A and we'll discuss them.
All right, I hope you can hear my voice. Jono says that you need to give my video back in case anyone does want to see me. So there are a couple of questions that came through while we were chatting. Thank you so much for sending those questions through. One of them was just a point of clarity. So there was a question saying, well, how can we imply that you could be overinsured after retirement age? And the short answer is we weren't implying it. I apologize if the graph was misleading. The point we wanted to make is that people are overinsured up until retirement, and then after retirement actually are unable to retire or afford to retire. The second question, which I think is an interesting one for us to possibly have a discussion around, is this idea that I made the point that life insurance shouldn't be there to enrich you. It should make you financially neutral. But very often we are putting life cover in place to enrich our families, to enrich our children, and to leave a legacy. And I'm definitely not trying to imply that that is the wrong thing or a mistake. I suppose what we are challenging is whether that is always appropriate, given that very often we are forced to make trade-offs. So for the type of customer who has got everything in place, who has put sufficient retirement savings aside, who has all of their income protection in place and is fully covered, I think then opting to take additional life cover to leave a legacy for your children is a wonderful idea. My concern, though, is that most clients I come across or have seen have opted to do that, but do not have sufficient cover in place in many of the other needs, or have not put enough aside for retirement. The consequence of that is that the reality is you are more likely to live to retirement than you are to die before you retire. So if you put all of your money aside and made sure that you have this beautiful life cover in place to leave for your children, without taking care of your living benefits, without taking care of your retirement planning, you then have the risk that you become a drain on your family or on your children during your retirement and create massive financial stress on yourselves and on them, only to have this massive insurance payout if and when you die later. So again, to kind of make my point, it's not about leaving a legacy as a bad thing. It's about considering where it is in the space of the other trade-offs and the balance of priorities that we need to assess. And our view is rather prioritize living benefits, retirement savings, and then make sure you have enough life cover before you're in a position to top up your life cover and have more than possibly you need. Just make sure that I have addressed all the other questions. Give me 1 second. Yeah, and related to that question was also the good one, is that you've been paying a premium for this life cover. Now, what do? It almost becomes an investment policy at a certain stage. You know, you've been paying this premium for 20, 30 years. You get to a point where you continue to pay it. And again, just to reiterate from our side, we're not saying that from today, you must go and, replace all lump sum cover with life income cover. That's definitely not what we're implying. What I believe the thing about life income is that it gives you, as a financial planner, an additional tool to add to your financial planning toolkit. And in addition to the 6 very specific sales opportunities that Jono outlined, I think there's a broader discussion to have to say, well, how can this apply to, as a financial planner, to your portfolio of clients? And almost every single advisor I speak to talks about the same concerns. It's increasingly difficult nowadays to attract new people into life insurance, to find a way to make life insurance relevant and accessible to the younger market. The other challenge is that, particularly now where the economy is, almost every single client is looking for ways to save money, looking for ways to reduce their premiums. And I guess linked to that is this risk and this extra burden that's been placed on financial advisors to perform annual reviews and to do them thoroughly and carefully. And we believe that life income gives you an option, gives you an extra tool that helps reduce or improve all 3 of those situations for you. So if you look at your typical if we almost go back to one of the opening graphs, there is an entire market in the country at the moment that has simply not entered the life insurance market. And for the younger people who don't have life cover in place, we think that life income is a great way to start the life insurance conversation. It makes the benefit relevant, it makes it accessible, and more importantly, it makes it extremely affordable upfront. So we think it's a great way to attract new people in. For the customers who already have cover in place, but perhaps don't have enough, again, we think life income gives you an amazing new conversation to have, to supplement the cover they have, to top it up with income benefits instead of simply just increasing the lump sum that they have in place. And use some of the specific opportunities that Jono discussed to effectively meet very specific needs, but in doing so, increase the amount of life cover that they have. And then the third opportunity is for the clients that we believe have got more life cover than they need and have been unable to meet all of the other needs or all of the other financial planning requirements. And I had an amazing discussion with an advisor 2 or 3 weeks ago. He said he's got a portfolio of 250 clients. Firstly, he's struggling to find the capacity to actually perform meaningful annual reviews with every single one of them. Secondly, every single one of them is saying, reduce my premiums, but also we need to save more to retire. And when we looked across that portfolio, typically the clients that were in their 50s, by rebalancing from a reliance on lump sum benefits to life income benefits, you could save 20 to 25, in some cases 30% of the risk premiums. Now, across a portfolio of clients, that's a significant savings that allowed that planner to have completely different discussions with his clients and start having investment and savings discussions with the income that was then freed up. So really, that's all we're hoping that this morning's discussion brings, is it brings possibly a new way of thinking. It asks some questions that maybe you haven't been thinking about up until now. But more importantly than that, it gives you one extra opportunity. It gives you another conversation to have with your clients and another option that's available to you to supplement cover that's already in place, to look at possibly rebalancing from lump sum to income and saving premiums, or even a great conversation to have to bring an entirely new young person into the life insurance net for the first time. And we're really grateful that you joined us this morning. We really appreciate just how valuable your time is. We don't take it for granted. And we'll stay online for a little while now. If there are any other questions, I'm happy to keep chatting and happy to keep answering. But we hope that this has given you something to think about. And the entire Icon team is ready and waiting for you to engage and contact us, and we're ready to help.